You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome everybody to another podcast of A Smarter Way Home. Modern mortgage strategies for home buyers and real estate professionals alike. I am Victor Bals, licensed loan officer, 20 years, and I am here with my wonderful co-host, Mrs. Danielle Boote. How are we today?
I am fabulous today, Victor. Good to see you again.
It is a great day. It's fall, and we are. What do we call it? Tweening. Twinning.
Well, I guess.
Twinning is somewhat. We're twinning here, but anyway, today's show, as we talk about home ownership, I want to talk about things not to do. And I actually ran some data today, so I want to kind of set the stage. So as we talk about home buyership and we talk about people getting pre-qualified, I ran some data in the last couple days and for the last 2 years, and I looked at the percentage. And there was about 800 loan applications, and it looks like we had closed about 350 loan transactions. And when I look at that data, it looks like, and I believe this is nationwide across all lenders there, is that about 60% of these people end up not closing or they're not qualified. And as I started to look at the data, it's not that they're not qualified. They're not qualified right now. And so when I was looking at the data, I said, God, it's not if a person could be qualified, it's when a person could be qualified. Do you kind of get that same feel, Danielle?
Absolutely. There's a huge level of financial unpreparedness and I think a lack of financial education. And it's not just first-time home buyers.
Yeah, I see. Yeah, and what I'm seeing is it's just uncanny how, we'll get a call from a client and says, hey, I was looking at online and I want to put an offer in on this house. And this was, 20 minutes ago, they weren't doing anything and then all of a sudden right now they want to buy a house. So emotionally they want to buy a house. They come to us for a pre-qualification and come to find out they can't. And we pop that balloon, and many times, working with customers, I see that the customers think that it's almost the lender's fault because, it's just tough guidelines. And the fact is no, guidelines are pretty easy. Sure, they're, I guess, somewhat tough. You got to meet the guidelines, but it's really 99% of the time, it's on the borrower's inability to be qualified right now.
Correct.
And so I wanted to kind of discuss some of the things that we want to let our consumers know about. If you want to buy a house, I guess the best advice that I think we can give is get prepared. You don't go to the Army without going to boot camp and learning how to do what you do before you go out there and battle. And buying a home or getting a mortgage, some people think it's a battle going through those lenders too. So I want to discuss a little bit about some of the things that people need to be prepared for or why people get disqualified for a mortgage. And there are two things that the lender is going to look at right out of the bat here. And that is going to be credit and job stability and income. Those are the two of, if I'm missing something else, Danielle, correct me.
No, those are the main two things. And let's talk a little bit about jobs.
Okay.
There's kind of a big transition going on nationwide. Some of it's COVID related with all of the industry changes, how employers are changing. When we go to pre-qualify someone for a mortgage, we're going to ask for a 2-year history of all their jobs. Mm-hmm. When we need start and end dates And we need basic employer information, the name, contact information from any current or previous employer. And then, of course, the corresponding documents. But some of what I'm seeing in the market with consumers calling is people that have gone self-employed.
Yeah.
They were W-2, maybe hourly, maybe salary, and now all of a sudden they're 1099 and self-employed, which that requires a longer history to be able to document. Those types of income changes people don't realize. I had a client recently, the true story, young couple looking to buy their first house. I pre-approved them months ago. I gave them all the warning signs, right? Don't do this, don't do that. Took them a while to get in contract on the house. Well, they called me about 2 weeks ago and said, well, we found a house, we want to write an offer on again. And, but we've had some job changes. So both people changed jobs. Luckily, the gal got a better job and making a little bit more money, but the gentleman is now 1099, independent contractor, self-employed for less than 60 days. And he, even though I warned them, they didn't think to call me. So luckily, they were buying and were in a position that the young lady could get the mortgage on her own.
With her job.
With just her one job. Okay. But that could have been, luckily they weren't looking in a higher price range.
And this goes down to communication with the lender on a regular basis as well. So for the consumers here, if you're in one of these situations, if you are thinking about buying a home in the next 2 years, just kind of make note of these yellow flags. And we're going to talk about each one of these yellow flags. If you are switching jobs or if you're switching careers, if you're going from full-time to part-time, or if you're having a full-time job and you're trying to use a new part-time job for income, maybe you're working 2 part-time jobs, going from salary to commission, using commission to qualify, self-employed in the last 2 years, you started a business, going from salaries hourly to a salary plus commission, or maybe you make tips, or there could be some other variable type income. These are all yellow flags. And if you're in that box, you want to contact your lender and set that stage much earlier in the process so we can avoid these mistakes. So let's break these down. So let's talk about switching jobs or careers, Danielle. What is the guidelines on that?
Well, we want to see that if someone changes companies, that they're in a stable position. Typically we're going to want 30 days worth of pay stubs from a new employer. There are some exceptions if you're transferring for a job. So, for instance, somebody coming out of state that has a signed job offer letter and it makes sense and probably salary, we might be able to use that with before pay stubs. But for the most part, you have to be started on the new job and you have to have pay stubs.
And these are for W-2 type individuals, not 1099 or where you're deemed a self-employed. So switching
Correct.
jobs is okay. It's just a matter of having the paper trail and making it make sense.
Right. We really don't want you changing jobs 2 weeks before closing. So if you get to the point where you're pre-qualified, you write an offer, it's accepted, you're in the mortgage process, that would, in most cases, I'm going to say is a hard stop no. Please do not change your job prior to closing, because we're going to verify your employment a few days prior to closing. You better be on the job. You better not have resigned, because all of a sudden that's going to derail the whole mortgage process.
You will either be denied or it's going to put a big delay until we can get the paper trail together.
Correct.
Okay, let's go. Let's talk about going from a full-time position and now, you know what, I'm going to stay home and take care of the kids. I'm going down to part-time. How does that affect my ability to get a mortgage?
Well, that is very tricky for us to average any type of income. So if it's something that has been very recent, we might not be able to deem how many hours you're working and come up with an average, because it's not going to be reflected in your 2-year history.
Okay, so if I went from full-time to part-time, one, I cut my income in half. Mm-hmm. And then there's the ability, is it stable? Is employment likely to continue?
Correct.
So these are some of the questions that the lender is going to be asking you so we can document that your job is stable and that we can use that income to qualify.
Right.
Let's move on to having a full-time job and trying to use a new part-time job because I'm making extra money. I want to afford that house. How would that part-time job affect me, Danielle?
Well, unfortunately, it won't, because
And why
if
is
you
that?
do not have a 2-year history of working 2 jobs, we cannot use any of that secondary income. So a part-time job may help you save for down payment and closing costs.
Okay.
If your intent is to say, hey, I'm going to get a second job and I'm going to save all that money to put towards the house, that's okay. But we cannot use it as qualification income because we do not have the stability.
So we did not have the stability, or is it likely to continue? That's
Correct.
why we want that 2-year history. Okay, so I have clients that they work 2 part-time jobs. How does that affect my ability to qualify for a mortgage?
It goes back to a history. If you have a 2-year history of working 2 part-time jobs and they seem stable and likely to continue, then that would be okay. There are some fields where it's common that people have 2 jobs. Frankly, in the medical field, I have clients that sometimes are nurses, respiratory therapists. I've had nurse anesthetists that might work at 2 hospitals. But that's a stable career path, and it's not uncommon for them to, or dental hygienists. Dental hygienists typically don't work full-time at most dental practices. So sometimes they'll work at 2 dental practices, but then we have a history, we have stability, and that's typical for
And
the
it's
industry.
likely to continue.
It's likely to continue, and we
Okay.
can verify that as such.
Okay, let's talk about these people. They work part-time. They may have a spouse that works full-time, and they work a part-time job for extra money, but they take on another part-time job. Okay, can I use that second part-time job for income?
Not unless there's history.
Again, 2 years.
2 years, yeah.
Okay. I work a job, but now I have a little side business. It's 1099. I do something. I got a home business. I sell stuff online. Can I use that income?
With a 2-year history. And then it would have to be documented on your tax returns.
Okay. So the tax return. So now I'm a W-2 employee. I have a self-employed. I started a new online business. I need a 2-year history. But also because I have expenses, I write all those expenses off because it's great for tax purposes. Right. How would you treat those expenses on those tax returns for qualifying my income?
Well, depending on the situation, and that's kind of getting a lot detailed, but if we see a business history of losses, we might have to hit you with those losses.
You mean count those losses against my
whatever your
income?
normal income is, yes.
Wow,
yeah,
so
because you're saying, hey, I'm losing money here. We look at that and go, well, that's an expense that you have personally, so we're going to hit you with that loss.
So they would take that loss and take it out of my regular W-2 job income that I make.
Potentially, yeah.
Wow, so that could hurt.
And there's a fair amount of people out there that, let's call it a hobby business, that
Yeah.
that can be very problematic with.
Absolutely. So
Lots to consider with your income, and one of the things that I find that's been a little bit more challenging the past few years with all of the online tax service things is that a lot of people do their own taxes, with an online preparer, and they don't always file right.
yeah.
And then that when if we have to look at those tax returns, we're opening up a can of worms and go, well, what did you do here? Why is this like this? When if there was a CPA involved or a trained tax preparer, I know that they wouldn't have filed them. And I'm not a tax expert, but I've been looking at tax returns for people for over 30 years. So,
and that'll get caught in underwriting, and now
Yes.
they're gonna cause questions, could cause delays in your transactions.
correct.
I have a lot of people as well that use the online tax services there, and they forget their passwords. They can't even get us copies
Yes.
of their tax returns.
Yep, absolutely.
So that's so remember your passwords in that. But again, this is up to our consumers to get with your lender, work with them well in advance if you meet one of these potential yellow flags on income stability.
Yeah, and one of the biggest issues that we have right now, and we've talked about this on other episodes, is the income stability issues and the additional guidelines that all lenders have right now because of COVID. So we have to look at your current year to date. Now it's the middle of October, right? So the year's almost done.
Yep.
But a lot of people had income interruptions last year, whether they were furloughed for a while, laid off for a period
Or
of
the
time.
beginning of this year due to
Or the beginning of
still
this
COVID.
year due to COVID. So sometimes we're looking at people's income and they've recovered this year and are doing well. But again, if it's variable income, it's overtime, it's bonuses,
It's tips.
we're going to look back at least a year and a half, if not 2 years. So right now, 2020's income reduction for a lot of people is still impacting what they can qualify for. And it absolutely impacts self-employed borrowers because they may have shut down their business for a couple months last year.
Especially the service businesses.
Right. And we have to use last year's numbers. We're going to look at this year to make sure that they're still earning, that, business is operational, something of that nature. But in some cases, that the way we have to average is going to impact what they can qualify for. Now, I personally am very excited for our calendar year to end and for people to get their 2021 W-2s.
Well, it's funny because you helped me with that scenario a couple of weeks ago where I have a client self-employed as a paint business. Right. And of course, the first half of 2021, they were shut down because of COVID because the governor says we can't go in anybody's house. There is no service to anywhere. Yeah. And so he had to supply a profit and loss statement, which technically we can't use, but
we have to pay attention to that now.
We have to pay attention. And of course, his income is starting to recover, but you had advised, can we wait just to the next tax year because his business is picking up.
Right. So when we see 2021 end and we have people's W-2s, then we get further away from all the implications of 2020 or early 2021. And then hopefully we'll see on paper more solid income. We're getting income challenges like this every week right now. The amount of people that I see that go, I was a carpenter, hourly W-2 employee, and now they're self-employed. Right. And you've got a year and a half in the business. Hairdressers,
waitresses, bartenders.
They don't go, a waitress or bartender won't go self-employed. They're going to have the more variable income issues, but there's a lot of people that have all of the sudden gone self-employed or independent contractor situation.
Thus, meaning we need 2 years tax returns.
We need 2 years tax returns or at least a solid year and a half. And the other, again, it goes back to the write-offs. If you start up a business, you're going to have probably heavy write-offs the first year, which is typical. A lot of investment goes into a new business, but that impacts your tax return.
Absolutely. Mm-hmm. I stumbled upon about tip income. Let's talk about tip income because at the beginning of 21, everything was shut down, but now businesses are opening up and our servers are getting more tips. How do they look at tips?
Typically, we're going to want to average that over 2 years. Now, with tip type income, there's two ways that I'm aware of that it can be handled. The business establishment can track tips, reported tips, and put them on their pay stub and put them on a W-2. Okay? Yep. They might be in the W-2. Or another situation is that the employee has to self-report to the IRS. I believe the limits are right now. Anything over $600 that you earn from some place that is not tracked on a 1099 or a W-2 is supposed to be self-reported.
$600 per year, per week,
per year.
Yeah.
So if you earn tip income and your employer doesn't report it on your W-2, you're supposed to self-report it to the IRS and pay taxes on it.
And if you do that, we can use that reported
Correct.
income.
If you don't claim it, we can't use it because we can't see it.
Okay, so let's talk about this particular individual that makes tip income. And let's say in 2020, they did real well. 21, because of COVID, their tip income because they were shut down. And now they're starting to recover. Are underwriters going to look at that recovery and count as like, hey, we're back to normal, or are they going to chop that income?
Chop. Yeah, we're gonna use the most conservative income average. So especially the restaurant industry has been hit hard. They were in Michigan. They were closed down for several months. Right? They were closed in spring of 2020. Then they got shut down again in the end of the year in 2020 into early 2021. So for those employees, it's going to be difficult. In fact, I don't think I've had, well, I shouldn't say that. I have one client that's in the restaurant industry, but he's salary. He's kind of in a little bit of a higher position. I haven't seen any clients that are servers or bartenders inquire about mortgages in the last few months. That I can recall.
So as you know, we talk about these yellow flags. I want to go over them one more time. So if you're thinking about buying a home in the next couple years, just yellow flag yourself if you fit into one of these boxes, that you're switching jobs or careers, you're going from full-time to part-time. Maybe you have a full-time job and you're taking another part-time job for income. You're working 2 part-time jobs. You're going from a salary to maybe a commission position, or we're using just commission only to qualify, and you've been affected by COVID. And if you've been self-employed or you just started a new business here, these are going to be yellow flags, and we highly advise get with your lender to set that stage and say, what do I need to do to position myself, and get that advice of the lender. Anything else on that?
No,
Danielle?
not on income. I think the next big thing that we need to talk about is credit. And let's talk about some of the challenges that we see with borrowers that are unprepared with credit.
Yep. So first we talk about we want to get your income stability, but then the other thing why people get turned down, or they don't get pre-qualified, or they may get pre-qualified for a lesser loan, or maybe not the sharpest knife in the drawer, the best loan product out there, and that is credit. So let's go ahead and discuss credit a little bit. You know, what credit scores are we looking for, Danielle?
Well, in our world, we are looking for a minimum of 580 for FHA, at a minimum of 620 for conventional, 640 for rural development.
And you mentioned 620 for conventional, but on the conventional loans, that 620 is going to affect your interest rate. Could you explain how credit does affect interest rates on conventional loans?
Well, conventional loans are priced based on your down payment and your credit scores. So the higher credit score, the better interest rate you're going to get, and lower fees. The lower the score, the higher the interest rate, higher fees. So when we talk about fees, it could be the cost to get the loan. It could be private mortgage insurance that will be impacted. And these are fees that all lenders are affected by that come down from the agencies such as Fannie Mae and Freddie Mac. So we're all following the same rules. But the higher the credit score, the better off you're going to be.
Yeah, the higher the credit score, the less risk it is for the lender.
Yes, and there's buckets too. So, you know, for instance, if you were above between 640 and 680, that's one bucket. 680 to 700, that's another bucket.
And each bucket has a different interest rate.
Correct.
Okay.
And a different PMI rate. So our goal, or my goal is when I work with clients, is I want to optimize their credit situation. You know, if they're at a 679 and we think we can get them above 680, I'll give them that information to educate them and say, hey, you know what, why don't you do this or this? By the time you find a house, we might get a better credit score. We certainly don't want anyone to start the pre-qualification process, do things that would hurt their credit, because that sometimes happens too. So part of that pre-qualification is educating our consumers on what is good to do with your credit, what is not good to do with your credit, so they don't make mistakes in the process.
Again, basic training and being well prepared in a couple months in advance.
Yes.
You know, as we talk about credit, in 20 years, I have never seen a client that we couldn't help improve their credit scores or better their position, you know. And as we talk about credit, but some of the things we look at here is, you know, the credit scores are too low, that maybe you have minimal trade lines. You have, I pay cash for everything. I was told not to do credit, just pay cash for everything. Let's talk about minimal trade lines and how that affects scores and what lenders look for, Danielle.
Yeah, depending on the loan program, we really need to see established credit for at least 12 months. And what most programs want to see is 3 trade lines. So what is it? Yeah, what is a trade line? A trade line is an account. Okay. So you might have a credit card, a car loan, and a student loan. Those would be 3 separate accounts or 3 separate trade lines.
And what if they're all closed? I paid them all off.
Well, if they're closed, they still impact your score, but they don't have as much weight on your score because they're not active. And we want to see things that are open and being used responsibly.
So you could show that I have the ability to pay and manage
Correct.
my money on a monthly basis.
And if you're in a situation, everybody's situation is different, but if you're younger, you've just been building credit for a few years and you open something, pay it off and close it, it could have a bigger negative impact on you because it wasn't open that long in the first place.
So there's a lot of variables.
There's a lot of variables. Like I had a gentleman I talked to a few years ago. He had excellent credit, was in the mid 700s. He didn't have too many accounts, but he graduated from college. He paid off his student loans, got a good job, was saving money, was really proud of what he was doing. Then guess what? He paid off his car. He was proud of that, closed that loan out. Then he thought, I don't need any credit cards anymore because I'm going to pay cash for everything I need. So I pre-qualified him for the mortgage. It took him a year to find a house. And when he called me, I re-pulled his credit, and his credit scores had dropped 100 points. And it was because he literally closed everything.
And the lender has nothing to measure his credit history from anymore.
Not much, no, or the credit bureaus don't. You know, that the bureaus are going to measure that past history off of what is open, what was in the past, and he did too much at the same time. Like and I have also
Shut it down.
Shut it down. If you don't have any open credit for 6 months, your credit scores will likely disappear.
Wow, that could actually hurt you there too.
Yes. Yep.
So let's, I'll end up pre-qualifying a client there, and we pull the credit, and I'll say, hey, you got a collection on there? And they say, I do not. I go, yeah, here's a $50 collection from XYZ. And a typical response is, the insurance company was supposed to pay that medical copay, and out of principle, I'm not going to pay it because they were supposed to. Well, it just cost you 80 points on your credit. Right. Can you respond to that? Do you get this situation, and what do you advise?
Absolutely. Well, here's what I advise. Consumers need to be in charge of their credit history and their credit score. And they need to know, but they need to get their credit information from a reliable source. So I recommend consumers can pull their credit report for free once a year from all 3 of the credit bureaus through annualcreditreport.com. They won't give you the scores for free. So if you need the scores, you're going to have to pay a few dollars to pull them. I don't recommend Credit Karma or any free app. You should never give anybody or any app your social security number and think that they're going to give you a true credit score, because they're not. But consumers need to be responsible and look at their credit. Mistakes happen. You could think you have perfect credit and something fraudulent comes up and you're ready to buy a house and we pull it and go, well, what's this? They go, well, that's not mine. Well, now you got a fraud thing that's going to take you at least 30 days to clear up.
And you're trying to put an offer on a house, and now we've got this bug in the system that it has to be worked out.
So consumers should look at their credit scores at least once a year. How about, for instance, one of the problems that we'll run into on consumers' credit reports is excessive inquiries. Mm-hmm. So they don't know what their credit is. Maybe they decide to buy a car. They walk into the dealership. That dealership might pull their credit 12 times. Because
they ship it out to different brokers, because the consumer wants the lowest rate in the world, shop it out.
And I think the dealer probably will get compensated, right, from referring them to a particular lender.
Possibly.
So, for instance, when I buy a vehicle, I'm either going to walk in with my own financing already prearranged, or I'm only going to lease from, for instance, the manufacturer, so that I know, hey, if I buy a Ford, I'm getting Ford credit financing, so my credit doesn't need to be pulled 12 times. But consumers that maybe don't have the highest credit scores can walk into a dealership, not understand what they're doing, and they're going to have 12 inquiries.
And that could cost them 40 points.
It could. Even if it's multiple pulls within a short period of time, it's not supposed to impact your credit. But it does, especially if you don't have the most established credit. And again, the consumer is surprised. I mean, I've had people come to me going, I'm paying 10% of my car loan. Well, they didn't have the best credit to begin with, but they didn't work to prepare for even a vehicle purchase.
Right.
And they're going to go, well, I needed a car. Well, then you're going to finance with a B-rated lender who's only willing to lend to you instead of, again, being responsible. And don't bury your head in the sand.
Yep.
That never works with your
if
finances.
you're going for a house, we got to do a reality check, man.
Yeah.
And here I'll have clients call me and we'll talk. We'll discuss a mortgage and that, and say, hey, I really need to pull your credit. Oh, I don't want to have my credit pull. It's going to kill my scores. And I'll explain to the consumer. I go, well, when you have a mortgage credit pull, you can actually have up to 9 mortgage credit pulls in a 45-day period without it affecting your score. But if you go down to the dealership or if you go to the department store and try to open up that credit card because you get 10% off your first purchase, those are revolving credit and other type installment debt. Each one of those pulls could cost you about 4 points. And the consumer doesn't really understand that. But lenders are, the credit bureaus, they understand you're going to shop around for a mortgage, so it doesn't have as big an impact in that first 45-day period. And I highly stress, you still need to get a reality check from a reputable lender or someone you want to do business with so we can evaluate credit, look at your situation, how can we better your scores and better position you for a better mortgage.
Right. And one of the other issues that we see pop up frequently is co-signing for someone on an account.
Oh, yeah, the old co-signer.
Yeah.
Let's dig deep.
So you may have somebody co-sign for a child, an extended family member. It could be a boyfriend, girlfriend, significant other situation that somebody co-signs. I've seen people student loans is a big deal with parents. The Parent Plus loans will show up on a parent's credit report. Vehicle loans as well is huge. Well, I co-signed for my significant other so they could get a better interest rate. Well, the problem with that is you are responsible for that debt if the person borrowing the money doesn't repay it. So we are going to count that against your debt to income ratio. It will also impact your credit if they don't pay on time.
Well, I've had that situation. Yeah. Mom and dad came in for a mortgage and we're rock solid. Our credit is absolutely stellar. I go to pull credit and it was down in the 600s for the mother. And she goes, that can't possibly be. Yeah. And I go, well, look, we've got 15 30-day lates on this car payment. And she goes, that's not my car. That's my son's. And I go, well, you co-signed for him, didn't you? She goes, well, yes, I did. I go, well, it looks like he was late 14 months ago, 30 days late. He didn't make that payment, but the next month made that payment, and it became a rolling 30-day late 15 times, and now it destroyed mom's credit. And we couldn't qualify her for a mortgage because of that.
The worst scenario that I've ever occurred in my career was a similar situation. I had an older couple. They needed to refinance their home to do some home improvements. So they had a ton of equity in their home. They had lived there for a long time. I think they were like retirement age, so they were on a fixed income. I go to pull their credit, and their scores were in the 500 range. And I looked at it, and there was a mortgage on there. And I knew they didn't own 2 houses, so I had to call them and say, there's a mortgage on your credit report, and it was in foreclosure.
It was in for, so dig deep. How did this all come about?
They co-signed for their daughter who had gone through a divorce.
Okay.
She was struggling. She never said anything to mom and dad.
Let the house go to foreclosure.
Let the house go. She was still living in the house, and they had no idea. And, of course, they did not have money to be able to help bail her out.
So let's say, now the parents' credit is destroyed. So now technically
they have a foreclosure on their
record.
have
a foreclosure, and they can't get a conventional mortgage for 7 years, right? Or a government loan for 3 years.
Right. So, situations when you co-sign for anyone, my recommendation is that you better treat this like a business transaction.
You treat it like it's your own debt.
You bet, and we're going to treat it like it's your own debt. So you better think long and hard about those situations. I mean, you talk about the significant other situation. and this is always challenging, I've seen people break up.
Yeah.
That significant other is no longer a significant other, and you have a $700 or $800 car payment. Now, if the credit history is not bad, we can exclude that debt from someone, but then we need proof that the person that is paying the debt has paid it for at least 12 months without interruption out of their own account. So, for instance, mom and dad co-sign for a kid. They hand the parents cash for the car payment. Nothing we can do. Okay, we cannot remove that from their debt to income ratio because we cannot track cash from the child to the parents. The only way we can exclude it is if, again, the person that for instance, the person driving the vehicle makes the payments, and we can get 12 canceled checks or proof that there have been 12 electronic payments or something made from the other person's account.
So it gets a little complicated.
Very complicated. And student loans are the same way.
And a lot of times when these significant others go away, you can't just go get 12 bank statements showing they don't want to give up the bank statements showing that they paid it on time.
Even in divorce itself can be tricky, but honestly, a separation of a significant other situation with credit involved, nightmare.
You talk about divorces. Several times we've seen where one of the spouses is the one spouse wants to buy a new house because they just got divorced, and the other spouse was awarded the house, and they ended up being late on the house payment, affecting the other spouse's credit, and it becomes a nightmare.
Yeah.
Well, the judge awarded them the house.
That's fine.
That don't matter. You both signed that promise to pay, and that is what is on your credit.
Right. So in a recent divorce situation can certainly complicate somebody's credit portfolio. From top to bottom. And again, being prepared, let's look at it early before you start looking at houses, because buying a house is an emotional process.
Right. So
you're going to fall in love with the front porch and the gazebo in the backyard. And
so just don't jump in. I guess you got to kind of go to boot camp, and you are Danielle Boote. We got to go to boot camp, right? Boot camp. Come on over to boot camp for 6 weeks.
Hey, I've never thought about that. That might be a good tagline.
That's not a bad. We're going to have the new boot camp.
Yeah.
But it really is about buyers being aware, self-aware of what their situation is and what they qualify. Because we've been doing this lending a long time, and these guidelines aren't that tough. But people, you got to consider, you may be a square peg, and we are a round hole, and it's not going to fit. We got to make you a little rounder to fit right into the system, and we can guide and advise you.
It's learning, isn't it?
Yeah.
I remember I got in the mortgage industry when I was 19 years old, and I think I bought my first house 6 months later. And the thing that I told my husband was, well, this isn't hard. This isn't hard.
Yeah.
Once I realized how the whole process worked, getting a mortgage is not really rocket science. Yeah. We're not quite geniuses here, right? We're not physicists or astrophysicists or whatever.
But the reason it was so easy for you because you were ignorant to the fact that you were actually doing things right to begin with, and you didn't know it.
Correct. And there's some simple principles.
Yeah.
Get a job. Keep it stable.
Maintain your credit.
And pay your bills on time. Okay? And we can help you on that path. And some of those things are they're just elementary financial education principles, but I'll put the word out there. There's a huge ignorance in society when it comes to your finances, and people will just bury their head in the sand. Well, I'm not going to do that. I'm not going to do that. I don't care about that. No, do the right thing. Right. Anybody in America can achieve the dream of home ownership if they follow a few simple financial principles, rules, and guess what? Anybody can do it. Anybody can do it. You don't have to have $1 million. I said to somebody recently, I said, the old adage, and I remember hearing this years ago and going, oh, that's stupid, right? But if you can't handle $1, you can't handle $1 million. A dollar is a dollar. And there's only zeros on the end of when you have one versus two versus 100, right? And it's, how many times have we heard people win the lotto and blow it in 18 months?
3 years later, they're bankrupt.
Most lottery winners within 3 years are bankrupt. Is that the lottery's fault?
No. It's comfort zone because people, to me, are they're a product of their own environment.
Yes.
And if they're always having financial difficulties and then just always something happening, that is their comfort zone. So if they were to hit that lottery, that's out of their comfort zone, and they'll do anything they can to get back to their comfort zone. So they will blow that money.
And we're a product of our environment and what we were taught.
Right.
Some of it comes from our family. Maybe a little bit of it comes from the schools, but honestly, I don't think that there are some finance classes, for instance, in U.S. high schools, but it's not like it's mandatory. Remember when home ec used to be mandatory or shop used to be mandatory?
Now we got microwaves. We don't have to learn.
Right. Nobody learns how to cook. Nobody does shop classes anymore. Nobody teaches anybody how to balance a checkbook. Does anybody even know how to get a bank statement?
Well, I went to the drive-through. They said, our computers are down, so we can't take your money. I go, you can't even add? No.
Yeah, no.
They couldn't.
One of the biggest tips that I give first-time home buyers that are struggling and trying to save for their down payment and closing cost, I tell them to put their debit card away. Yeah. Do you realize that when fast food establishments started accepting debit cards, remember when that occurred? Some of them used to charge you, right? They would have an upcharge when they started swiping cards. But think about in our younger years, what did you do? You went to McDonald's or Wendy's or Burger King, whatever. Whatever change was in your cup holder might be what you were spending. Yep. Okay? Remember, I had broke years. When you go, okay, I got $1.50. I can get a cheeseburger, and a small pop or something like that, and that is all you spent. But when the fast food establishments started taking debit cards, they almost doubled their per receipt transaction. So then people weren't spending $3 or $4 on lunch. They went to $5 or $6. $7 or $8, and it's significantly higher. I have seen people swipe their debit cards so heavily multiple times a day. It's an ATM, folks. Yeah. They're not paying attention. They're spending way too much money on non-essential things. I had somebody once that went to McDonald's every day and spent $1.06. Uh-huh. So they were getting that biggie drink. Yeah. 30 times a month at least. There were a couple of days where it was twice a month. And you go, that's a lot of money, folks.
Well, that $30 in that month buys about $7,000 in mortgage, by the way.
Yes, yeah. So you go, okay, and you wonder why they don't have any money. I tell people, live off some cash, put the debit card away for 30 days and see how much you can save. Because you're going to think twice before you go spend $1 on a sweet tea somewhere.
Absolutely.
Or come on, folks. Go to the grocery store and buy a case of Coke. If you're a Coke drinker, I don't care if you drink Coke. Pay retail for it. Don't pay, fast food prices or whatever. Well, I like the soda fountain. Well, do you want to? You can't live in your pop can. You shouldn't be living in your car. And just be a little bit more responsible. Be intentional and, do something different.
Well, you sound like my wife, Danielle, because you know me. I don't even have a debit card. I get an allowance every day.
Good for you.
And it's not what you make, it's what you spend.
No, and
right?
There's been times in our marriage that I took away the debit card and took away the credit card. I'm like, no. Like you can't manage it.
Right,
I mean, how do you balance the checkbook if two people are swiping on that same account every day? That right there will help you manage your credit, manage your money. I swear to God that I have saw someone once swipe at Starbucks for a $5 coffee, overdrafted their bank account, and had a $35 overdraft fee.
That was a $36 coffee then.
Right. And you know what? Here, let's talk about banks. One thing with bank statements, I bet consumers don't realize that we are going to scrutinize your bank statement. And if you have multiple overdrafts in your account,
you have an inability to manage money.
Yes, and an underwriter is going to look at that and say, what's the problem here? Everybody's entitled to a mistake. If you have 1 or 2 overdrafts a year, that's not an issue. I've seen people with 15 or 20 overdrafts a month. Yep. They can spend $300 to $400 a month in banking fees. That is someone that is not managing their finances well.
And let's look. These underwriters are going to be looking at your bank statements, and if they see these non-sufficient funds, these overdrafts, that's going to trigger a thought in the underwriter's head, if they can't manage their checkbook and they have a negative balance, what are they going to do for a house payment, which is 1,000 times more expensive than that dollar coffee?
Exactly.
So that could definitely have an effect on your ability to get qualified.
A lot of first-time home buyers might be living in a situation where they're not paying rent right now, right? Maybe they're still living at home, or they're living with friends or family, something like that, and they don't have a rental expense. If you're in that situation, that is absolutely the time to buckle down, create a savings plan, potentially create a debt reduction strategy, right? So that you're prepared. If you're living in a low to no expense situation, that is your opportunity to do something. Like I had somebody recently that wants to buy a house. They have been living with family for 10 years, married with children, 10 years basically living rent-free, and they have very little money saved.
Wow.
And you just go, well, they're nervous as all get out, which I understand because they're not responsible for much of anything. I'm not saying they don't have expenses, but 10 years living rent-free and, not having a better savings pattern, that's a difficult situation.
You talked about those non-sufficient funds, these people that maybe don't have a rental expense or a lack of expenses, and now they want to buy a home. So there's two things hitting them. Is one, if they have any of these non-sufficient funds on their bank activity, and now they're going from a zero rent to a house payment, there's underwriters are going to consider a payment shock on some of these loans. You're going from $0 a month to $1,000 a month a house payment, and you have non-sufficient funds. What's going on with your money there? So that could be a determining factor.
That's going to be a problem. That's going to be something that we're going to have to work on and clean up a little bit.
As we talk about, because I believe most people want to pay their bills on time. They're trying to save. They're good law-abiding citizens. Most people are absolutely wonderful, but life gets in the way with doctor's bills, collections. I lost my job, COVID. There's always life getting in the way. And these things affect your credit, your ability to make income, your job shifting. Remember, we got to live as individuals. And that's why it's so important to get in front of a lender, sit down, let's see the case, and let's build that story to get you that, like you say, that American dream. It's very easy to obtain by just following some very simple, basic workflows, work rules, just some simple guidelines and principles.
Correct. But educate yourself. And if you don't know what you don't know, that's a great time to call us. Like I have an appointment next week with adult children of one of my past clients. Yeah. So the mom emailed me and said, hey, my kids are in their 20s now. They're thinking about buying a house. Yeah. So they're not going to do it till next year. But they want to come in and sit down with me.
What a perfect situation. Yeah. Not till next year. Yeah. I want to get my act together.
Right. And who knows? They could be ready today.
And how many times have we had those appointments where, hey, I'm not going to buy till next year. You come in, you meet with them, you get them qualified, and all of a sudden that Friday night, hey, we found the house, we want to put an offer in on it.
It does. Yep. So, the time frame is up to everybody's, personal information to make, but get prepared. Yeah. Come in, get an education. You don't know what you don't know. Right. And again, the FBI.
Yeah, the fathers, brothers, and our in-laws, yes.
Yeah, you're not always going to get current information. It's not going to always be relevant to you. And, there's good information on the internet, but, trying to educate yourself from various sources can be dangerous. And again, it's not specific. People will call me and go, well, Danielle, what about my credit? What about this? What about that? I'm like, you know what? I need to look at everything. Let's sit down, let's look at it and create the game plan. Football teams don't come together and win the Super Bowl without coaching, working hard, right? All season long. Plus, what are the football players doing in the summer? they're working, they're training all summer long to be prepared for a 12 or 16 week season.
Yeah, and you can't just go out there and throw the bomb on every play, man.
No.
We got to have a playbook.
No, exactly. So, that pre-qualification process is building your playbook.
But and you got to think for the consumers, by building that playbook, it's absolutely going to help you for creating wealth, much more wealth by getting the best loan product, the lowest possible rate, and a strategy to use as little money out of your pocket or that you want to or that we have to give you options.
Right.
So let's go back to your home buyers that they're past customer children there. Now they're going to buy a home. So now we get them pre-qualified, okay? And they are out there looking for a home. I want to go into now the next subject is the things not to do once you're pre-qualified. So consumer, please remember, we got the things to talk about, credit and job stability. Let's get your plan, your playbook together to say, I want home ownership in the next couple years here. I'm going to work with a team that can help me understand the best options. And now that we've got you pre-qualified, here's the things that can make a transaction go south or go bad here. So Danielle, what are some of the things that one should not do once they're in a real estate transaction?
Do not quit your job or change your job position at all without talking to your loan officer first.
Okay, and what effect does that have?
It could stop the whole entire process or slow it down. So again, you brought up earlier, you could be disqualified for the loan. B, it could slow down the process.
Okay, I'm getting a promotion at work. How does that affect it?
Well, that in most cases will be fine, other than if you're on an income-based program such as rural development.
You're making more income.
You could put yourself out of
that product.
Understood. So again, a job income increase shouldn't be an issue.
Right.
But as long as it doesn't go. Here's a negative. I mean, any job change should be discussed first. You could have somebody that was salary that gets a promotion that then goes to a lower salary and commission.
Oh, game changer.
Game changer there. That's a complete.
Okay.
Even if it's the same company, that's going to be a huge problem.
Okay, so
there's a million employment facets. So I guess the biggest thing is don't make changes without calling your loan officer first if you're pre-qualified or in process of buying a house transaction. Because there's a million different scenarios. We can't possibly touch on all of them and end our podcast on that.
We can only educate you so much here, but it is about once you create a relationship with your loan officer, even in the early stages, constant communication and updates to what's going on in your life. Correct. Because everything you do affects that mortgage, it appears.
Now let's talk about assets.
Okay, what about assets?
Well, the big next thing not to do is do not deposit cash into any bank accounts.
Well, I just sold my snowmobile and I just deposited $500. How's that why would that affect me?
If we cannot track where the money came from, it cannot be used in a real estate transaction. So again, talk to the loan officer. If you're selling an asset and can verify it, we might be able to use it. But I have cash at home and I'm going to put it in the bank.
Okay, so
that won't work.
My mom went down to the casino, won $5,000, and she just gave it to me for the house as a gift.
Not
How
cash.
would that? She gave me cash.
You can use a gift. We can't use cash.
Okay? So if we can't trace it, we can't use it.
Right. So again,
and it's got to come from an eligible source.
Right. So that would be call your loan officer and let your loan officer up front know where, even a pre-qualification, we should know where money is coming from to buy the house.
My coworker lent me $5,000 to help me buy a house. How does that affect it?
Well, you're not going to be able to. It depends. Can we verify that you gave the coworker $5,000? And can we verify that it's coming from them?
And you can't use borrowed money. It has to be a gift and not a loan. You
can't get a gift from a coworker.
Yep.
So.
Oh, well, I'm just going to pull $5,000 off my credit card. Well, that's borrowing money to borrow money, which is against the guideline.
Yeah. Don't apply for any new credit during the mortgage transaction.
How would that hurt me, man? I'm trying to build my credit and apply for cheaper credit cards because I get better interest rates on credit cards.
Any inquiry that we see prior to closing, we're going to have to address and verify. So if you charge, let's say you go to a furniture store, spend $5,000
Oh, because I'm buying a house. I need furniture.
And you need new furniture. That is going to, could impact your qualification. Buying a car, buying anything with a fixed payment, all of that's got to be counted, but that's also going to slow down the process. So you could be disqualified, or it could slow down the process.
Well, I had a client, and we were going to close, and we were clear to close, and we had to do the credit inquiry check one more time. Come to find out that she went out and bought $15,000 in furniture, and because she was buying the neighbor's house, the neighbor let her move it in already, right? So they moved all the furniture in, but now she's got a $15,000 credit inquiry, a new trade line on her credit, and her payment was going to be $250 a month, where now the client did not qualify, period. We had to deny the loan.
Oh my gosh.
Or what she had to do is she had to return all the furniture, right? And then get it taken off her credit. We had to get an extension for 30 days because she couldn't qualify with that.
Oh
so
my gosh.
we got the deal closed, but again,
nightmare.
The customer wasn't telling me that, I got to go buy furniture. Anytime you're going to inquire on any credit, talk to your loan officer.
Right.
What else we got? The earnest money deposit. So when you go to buy a home, when you come under contract, the real estate agent is going to ask you for somewhat of a deposit to show that you're acting in good faith. Where does that earnest money deposit come from, Danielle? Who does that have to come from?
Well, it needs to come from one of the borrowers on the loan. And
one of the people that is labeled on the purchase agreement. Okay. Well, we were putting the offer in, and I didn't have my checkbook, so my buddy wrote a check for me. How does that fly?
Well, that's going to complicate things.
And how would it complicate it?
Because that's a gift from a non-acceptable source.
A non-acceptable source. Mm-hmm. So what would we do under that situation?
Well, in that situation, let's say our borrower has the money. We got to document him paying whoever back for that money, which is going to be just, again, layers of paperwork to add to the whole process.
Well, actually, and more delays.
Yeah, one of the things nowadays we run into is a lot of people don't have checks anymore, right? You pay everything electronically. I get it. Go to the bank or credit union and get a cashier's check. If you can take a cashier's check from your account, then that's going to be okay. With that we can source.
Okay, so let's move on to the next one here. As we're under a transaction now, is what we want you to do is check your email regularly. Sure, we'll be in contact with you, talking regularly, but as we request documents and then as our teams are working with you, you're going to want to check your email regularly because we're going to need, there's some tasks that you may have to do. Any comments on that, Danielle?
Yeah, you need to be accessible during the mortgage process. Everybody works. We need to be, whether it's phone, text, email, you need to let your loan officer know what your preferred form of communication is. Let us know if you have scheduling concerns, like if you work midnights and there's a good window to reach you during the day, you need to let us know, because sometimes we have borrowers that just don't respond in a timely manner, and that makes it very difficult for us to get the job done.
Right. And that goes down to submitting your documents. How and when do we want these documents when we're going through the process, Danielle?
As quickly as possible.
And how quickly is quick?
I like it the same day, personally,
But I would suggest, when we request something, that you respond within 24 hours.
Yes,
because
that
remember,
would be reasonable.
For every 24 hours you delay getting us that document could delay your closing by 24 hours.
Correct.
So timely delivery. Do not, and the earnest money deposit has to come from someone on the purchase agreement, and you're not opening up any new credit lines. Do not deposit any cash. Don't quit your job.
And here's probably the biggest one. Please continue to pay your mortgage and rent.
Oh, I'm selling my
time.
house. I'm not going to make it anymore because I sold it. Mm-hmm. How many times have we seen that happen where they stop making their house payment because it's going to be paid off at closing?
Yeah, even if you're refinancing, I tell all my clients, do not stop making your mortgage payment until I tell you we are ready to close. We have seen, in fact, just this week, someone that one of our loan officers is working with damage their credit because they refinanced last year and missed a mortgage payment before closing. Well, I thought we were closing, so I didn't make the payment, and then closing didn't happen right away, and they ended up being over 30 days late on a mortgage payment. Wow. So now we have a client that who sold the house, paid it off, and we're struggling to get proper verification and make sure they paid their debts on time. There is no reason to ever not make your payments.
Yep,
so
you
please
promise to pay it. If you overpay, they're going to refund
your credit at all times.
Yeah, and this also goes for the renters. Don't stop paying your rent. Don't stop paying any bills. It's not over till it's over.
Right.
You know?
Right.
Okay, so what closing words do we have for our consumers regarding the pre-process and the actual process?
Well, it's build a relationship with your loan officer. You know, make sure you understand the process, what's expected of you, plan early. You know, this is the perfect time. Even if you say, I'm going to buy a house next spring, this is a great time right now to have an initial consultation, to build your playbook.
Yeah.
Make sure you're ready. Look at your income, look at your assets, prepare for tax preparation time.
Go through boot camp.
Yeah.
I kind of like that. We're going to have to work on that.
Okay, we're going to have to play with that.
And with that, if you have any questions or concerns, you can email us, info@assistmyrealtor.com. That was Mrs. the Wonderful Danielle Boote. My name is Victor Bals for A Smarter Way Home. And remember, we got to try to get along.